You'd assume that owning a combat sports company means owning fights. You sign fighters, you rent an arena, people buy tickets. Some of them pay to watch it on their television. And the difference between what comes in and what goes out is your profit. That's roughly how boxing worked for most of the 20th century, and it's still how most fans picture the business today. It's not how the money actually works. The fighting is almost incidental. What you're really buying, if you buy a combat sports company today, is a monopoly on the only door fans can walk through to see something they can't see anywhere else, and a set of contracts that let you decide how much the people creating that content are worth. Understanding why those two things matter more than the fights themselves explains almost everything strange about how this industry behaves. Why a company can look enormously profitable while its athletes complain about being broke. Why a promotion can lose its biggest star and barely notice. And why the largest deal in the sport's history had almost nothing to do with fighting at all.
Start with where the money actually comes from, because it's not where you'd guess. For decades, the assumption was that pay-per-view buys were the engine, millions of households paying $50 or $60 to watch a single card. That was true once. It stopped being true as the business matured. The real engine became media rights, long-term deals with broadcasters and streaming platforms who pay hundreds of millions of dollars a year for the exclusive right to air the content at all. The UFC's move to a broadcast partnership worth roughly $1.5 billion over 5 years wasn't a bonus revenue stream layered on top of the fight business. For a modern combat sports company, that kind of deal is the business. Ticket sales and merchandise are almost rounding errors by comparison. This is the first thing that should reorganize how you think about the industry. You're not watching a sports promotion sell fights to fans. You're watching a media company sell exclusive access to content, and the fights are simply how that content gets manufactured. That reframing matters because it tells you what you're actually protecting when you own one of these companies. It's not the arena, not even the athletes individually, it's the exclusivity. If a rival network could legally broadcast the exact same fighters on the exact same night, most of the value would evaporate overnight. So before a single ticket is sold, the entire structure of the business is built around one goal: make sure nobody else can put on the fight you're selling, and make sure the athletes have nowhere else profitable to go. Everything else, the production values, the docuseries, the countdown shows, exists to make that exclusive product feel indispensable enough that a broadcaster will pay a premium to lock it up. Building that kind of exclusivity is expensive in ways that don't show up in a highlight reel. Before a promotion generates $1 of media revenue, it has to build credibility with athletic commissions in multiple countries, each with its own regulatory requirements. It needs enough depth in its roster that a single injury doesn't collapse a marquee card, which means paying and developing fighters who may never headline anything. It needs a broadcast-quality production operation, not a folding table one. And it needs years of consistent events to convince a network the audience is real and repeatable, not a one-off spike. None of that guarantees anything. Plenty of promotions have built exactly this infrastructure and still failed to land a media deal large enough to justify the spending. The fighting is the cheapest part of the operation. The credibility required to sell the fighting is the expensive part. Now look at the other side of that ledger, because this is where the business gets genuinely strange. In most professional sports leagues, players collectively bargain for a fixed share of league revenue. In the NFL and NBA, that's roughly half. Combat sports fighters have historically had no such mechanism. For years, independent analysis and court filings in litigation against the UFC put the promotion's revenue share paid to fighters at a fraction of that. Commonly cited estimates ran well under 20%, compared to the 50% norm in team sports, while the promotion retained the large majority of revenue generated by its events. That gap is not an accident of a young, disorganized sport. It's the direct result of how fighter contracts are structured, and understanding the mechanism is the counterintuitive core of this entire industry. Here's the term that explains it: monopsony. Most people know monopoly, one seller with no competition, able to charge whatever it wants. Monopsony is the mirror image: one buyer with no real competition, able to pay whatever it wants, because the people selling their labor have nowhere else to sell it. In a normal labor market, if your employer underpays you, you take your skills to a competitor. Fighters under long-term exclusive contracts with a dominant promotion that also controls champions clauses and matchmaking discretion don't have that option in any meaningful sense. If the promotion that controls virtually all the elite competition, the highest exposure, and the biggest paydays doesn't want to pay you more, the alternative isn't a rival with equal resources. It's a smaller stage with a fraction of the money and a fraction of the audience. That's not really a choice. It's the absence of one dressed up as a marketplace. This is where the healthy-looking numbers stop telling the whole story. A promotion can post record revenue, record broadcast deals, and record valuations. And every one of those numbers can be true at the same time that the people whose bodies are generating that revenue are earning a shrinking share of it. The metric that looks like success from a shareholder's chair can look like exploitation from a locker room, and both readings can be accurate simultaneously because they're measuring different things. Revenue growth tells you the product is working. It tells you nothing about who's capturing the value that product creates. To see how this actually plays out, look at the company that built the modern version of this playbook, Zuffa, the entity that owned the UFC.
In 2001, the UFC was close to worthless. It had been effectively banned from cable pay-per-view distribution in most of the United States, dismissed by a U.S. senator as human cockfighting, and was hemorrhaging money under its previous ownership. Two Las Vegas casino executives, Frank and Lorenzo Fertitta, bought it that year for $2 million alongside their childhood friend Dana White, who took over day-to-day operations. On paper, it looked like buying a dying regional wrestling promotion. What they were actually buying was an unregulated sport with almost no infrastructure and almost no legitimacy, meaning nearly all of the expensive, boring work described earlier still had to be done from scratch. State-by-state commission approval, rebuilding the athlete pipeline, years of losses before the product became sellable at all. It took most of a decade before that investment turned a corner. By the mid-2010s, the UFC had a national broadcast deal, mainstream stars, and a fan base that had grown far beyond its cult origins. In July 2016, the company was sold to a group led by the talent agency WME-IMG, backed by private equity firms Silver Lake Partners and KKR for approximately $4 billion. Frank and Lorenzo Fertitta's roughly 40.5% stakes each turned a combined $2 million investment into a payday reported in the range of $1.6 billion before tax. A return so large that outlets covering the deal calculated it as something like a 72% compounded annual return sustained for 15 straight years. That is an almost unheard of outcome for any business in any industry. But notice what that $4 billion valuation was actually pricing. It wasn't primarily valuing the fighters, even the famous ones. It was valuing exclusive control over the sport's biggest media rights, its brand, and its ability to keep the labor market locked down long into the future. The Fertittas and White didn't just sell an event business. They sold a machine for capturing value at a rate the athletes producing that value couldn't negotiate their way into. That machine had a weak point, and it had been sitting there since long before the sale. In 2014, a group of former fighters, including Kung Lei, Nathan Quarry, and John Fitch, filed an antitrust lawsuit against Zuffa, alleging the promotion had used exclusive contracts and its dominant market position to suppress fighter pay across the industry, not just within its own roster, by making it structurally difficult for rival promotions to compete for talent. It took a decade to resolve. A federal judge certified the case as a class action in 2023, finding that the plaintiffs had shown Zuffa, quote, willfully engaged in anti-competitive conduct to maintain or increase their market power. In 2024, the company, by then part of TKO Group, agreed to pay $375 million to settle the claims, after an earlier, smaller settlement offer was rejected by the court. Final approval came in February 2025, closing out claims covering more than 1,100 fighters who competed between late 2010 and mid-2017. A second, related case, covering fighters from 2017 onward, remains separately in motion. Sit with the size of that number for a second, because it's easy to let a headline figure like $375 million wash over you. Spread across roughly 1,100 fighters and weighted by each fighter's compensation and activity during the relevant years, it delivered life-changing payouts to some, reportedly over $10 million to the promotion's biggest historical draws, and far smaller amounts to fighters who appeared on undercards for a fraction of that exposure. It's simultaneously one of the largest labor settlements in sports history, and, measured against a company that would soon be valued north of $20 billion,
a manageable cost of doing business. That gap between historic settlement and manageable cost is the whole story of monopsony power in miniature. Even a landmark legal defeat doesn't necessarily change the underlying economics, because the buyer's leverage over the labor supply was never really about any single lawsuit. It was structural. And the structure kept scaling. In April 2023, Endeavor, UFC's post-2016 corporate parent, announced it would merge the UFC with World Wrestling Entertainment to form a new public company, TKO Group Holdings. On paper, combining mixed martial arts with scripted professional wrestling looks like an odd pairing. One is a contact sport with unpredictable outcomes, the other is closer to a soap opera with body slams. But the logic wasn't really about the fighting or the storylines at all. It was the same logic as the original UFC playbook, just applied at a larger scale. Two businesses that each already own near total control over their own media rights and their own athlete labor markets, combined into one company with more negotiating leverage over broadcasters and a broader base of exclusive content to license. The deal closed in September 2023 at a valuation of more than $21 billion, with Endeavor taking a 51% controlling stake. In early 2025, TKO expanded further, absorbing Endeavor's IMG, On Location, and Professional Bull Riders businesses in a $3.25 billion all-stock deal, before Endeavor itself was taken private by Silver Lake in a separate transaction that same year. This is the point where the optimistic version of the story and the realistic version start to diverge, and it's worth holding both up side by side. The optimistic case is straightforward. TKO controls an enormous, largely irreplaceable content library across two of the most durable live event properties in entertainment, with media contracts locked in for years and a merchandising and licensing engine layered on top. That's an unusually defensible business model, and it's part of why investors have been willing to price the company at such a premium.
The realistic risk sits underneath that same structure. Financing a merger and a series of follow-on acquisitions of this size added several $1 billion of long-term debt to the combined company's balance sheet, reported at more than $3 billion in the period following the merger. Debt of that scale isn't dangerous when revenue is climbing. It becomes dangerous the moment growth slows, a media deal renews at a worse rate than expected, or a regulatory or legal challenge like the still unresolved second antitrust case covering fighters since 2017 forces another costly settlement. A company valued for near-perfect execution has very little room to be wrong. And because so much of that valuation still rests on the same underlying mechanism, controlling exclusive content while controlling the cost of the labor that produces it, any legal or regulatory pressure on that mechanism is a risk to the entire structure, not just a one lawsuit's line item.
The rest of the industry watched all of this happen and adapted around the exposed flaw, rather than trying to outbuild the giant directly. The Professional Fighters League restructured its competitive format and built a compensation model explicitly marketed around revenue sharing and performance-based pay, positioning itself as the alternative for fighters wary of the monopsony dynamic that produced the Zuffa lawsuit in the first place. In boxing, promoters increasingly moved toward direct streaming deals, arrangements with platforms like DAZN that gave individual stars more leverage to negotiate as free agents between fights, rather than being locked into one promoter's ecosystem indefinitely. None of these approaches has matched the dominant company's scale, but they didn't need to. They only needed to be credible enough that "there is no alternative" stopped being entirely true, which is itself a quiet erosion of the exact leverage the dominant model depends on.
So what does owning a combat sports company actually mean once you strip away the image of arenas and knockouts? It means owning exclusive rights to content that can't legally be replicated anywhere else, built on the backs of athletes who, for most of this industry's modern history, had far less bargaining power over their own labor than the size of the revenue they generated would suggest. The best-case outcome for an owner looks like Zuffa in 2016 or TKO today, a media monopoly compounding in value for over a decade. The realistic downside looks like a company carrying billions in acquisition debt, still facing unresolved litigation over the exact labor practices that made its early profits so outsized in the first place, betting that scale and exclusivity keep outrunning the legal and competitive pressure building underneath it. The fights are real. The risk the athletes take is real.
But the business built on top of them was never really about the violence in the cage or the ring. It was about who gets to own the only door into the room where that violence is allowed to be watched, and how much of the money that door generates actually makes it back to the people standing on the other side of it.